Well, it's my job to welcome you all here to the LSE for what I think is going to be a really interesting occasion. And it's a great privilege for me to introduce old colleagues and friends on this occasion to talk about money, capital, monetary policy principles for a more prosperous society. No doubt our Chancellor can't be here this evening because she's got to sort the country out, but lessons to be learnt, no doubt. Let me just say a little bit about the event. This event's organised by the Department of Finance through the Financial Markets Group at the LSE. It's great to see that you've all come here. But let me just say a little bit about our speakers. First of all, I'll introduce our chair. By the way, I should introduce myself. My name is David Webb. I used to be the director of the Financial Markets Group for a mere 18 and a half years, and after that, head of the finance department and pro-director and CFO of the school. Charles Goodhart and I were colleagues have been colleagues for as long as I can remember. Charles, a very distinguished career. Started life PhD at Harvard, followed by stint at Cambridge, the LSE, and Bank of England, returned to the school in the mid-80s, where we taught monetary economics together for a number of years. So there are things for us to learn today. Patrick Bolton and Haizhou Huang, two distinguished economists, and once of this parish. Patrick was on the faculty of the school in the very early 90s, and has been a very good friend of mine, along with his wonderful wife Ailsa, who I'm pleased to say is with us today, and has had a great career after the LSE at Princeton, Columbia University in the US, and now at Imperial College in London. Haizhou Huang. Haizhou Huang is now linked to Tsinghua and Shanghai Jiaotong University. But Haizhou started his career after his PhD at, I believe it was Indiana, is that right? Yeah. At the LSE, where I gave him a job. That's correct, isn't it? Look, things change in life. We all progress, and sometimes the people you've appointed do better than you, right? And that's an achievement. You should all be proud of appointing people who do better than you. So I did. This has happened. And Haizhou, after LSE, went on to work at the IMF, Barclays Capital in Hong Kong, and then again, I never get the number of C's right in this bank. I think it's CICC.
Yeah, right.
Yeah, bank in Hong Kong, where he was at a very senior level. I think he had a title of something like senior advisor to the main man, but that meant he was basically number 2 or 3 in the organisation, so he's a pretty important guy. But he's now also a member of the Chinese Monetary Policy Committee. I don't know the name of it, but it's effectively their version of our MPC, and that's in Beijing. So it's going to be great this evening to have them present their work. Charles, which way are you going to play it? I think the organisation of play is that they will speak to the book, then you will comment on what they've had to say, and then we'll open it up to the audience for discussion. Is that correct?
We never discussed it.
That's standard practice. So I've done a few of these over the years, all equally badly, as you can see. But anyway, we're going to have an interesting evening. So I think, unless you want to say anything before Patrick and Haizhou, Charles, we'll hand over to what looks like Patrick.
I will start.
So Professor Bolton.
That's right. Okay, can everybody hear me? Yes? So it's obviously a great pleasure, special moment for us, for me, to be here at LSE. As you explained, David, this is where everything started. This is where I met Haizhou. And this is where I met Charles. So Haizhou, when we were here, colleagues, we didn't work together, but we had interesting discussions about lots of things in economics, things at the time. And then I met Haizhou again in 2001, 2002, when I was visiting the research department at the IMF. And Haizhou was at that time at the IMF, also in the research department. And that's when we started collaborating. We wrote a paper which has never seen the day, but has a few things that are interesting in it. Maybe later, if there's an occasion, we can say something about that. But anyway, so next thing that happens, of course, as David explained, Haizhou moved on to an industry job at Barclays, CICC, and then as we explain in the preface of our book, I on one trip to Beijing, I was giving a seminar at the Reserve Fund of China, SAFE. And the seminar I was giving was on contingent convertible bonds. The idea being that contingent convertible bonds are a good instrument or a good asset to invest in for long-term investors, reserve funds that can ride out a recession and therefore can provide some insurance, liquidity insurance, and contingent convertible bonds offer that. So contingent convertible bond, typically these are, well, at the time there wasn't a big market, but it's become a very large market. You may have read about some of these things in the press. So typically it's financial institutions, it's banks issuing contingent convertible bonds. And then the idea is that it's a bond with a conversion mechanism into equity. That's one form of contingent convertible bond. Okay? So there are various ways in which the mechanism works, there are various instruments, but the idea is that it allows the issuer some flexibility through the conversion to reduce, if you want, in a way, reduce the debt burden, right? Okay, so I was presenting this, and then we were stuck in traffic, and then we had a discussion. Could you imagine a sovereign issuer issuing a contingent convertible bond? Would that make sense? Because you have sovereign debt crisis. Maybe this is something that could also be used for sovereigns. And then, as the discussion went on, we asked ourselves, okay, but what's the analog of equity for a sovereign? So we understand how a bank converts debt into equity, but what's the analog of equity for a sovereign? And that was how we started thinking about our book, and started thinking that in many ways you can think of fiat money as the equity equivalent for a nation. Equity for a corporation, the analog of that is fiat money for a nation. That was how it started. And then it took us about 10 years to develop this idea, explore different directions, and that's the book that came out a few months ago. So let me maybe give you a few highlights from the book, and then Haizhou will take over, give you some other highlights, and hopefully I won't go on for too long. So here's sort of an outline. We obviously you might ask, well, what's the point of making an analogy like that? What do we gain by making an analogy like that? Well, we're trying to first make a case that there are gaps in current monetary thinking, monetary economics, gaps in the dominant doctrine, monetarism, that need filling, and that's why our perspective can add something. And then we turn to the main chapter, a conceptual chapter, money is equity. And then if you think about money as equity, then you can have a theory of the capital structure of nations. And then we build up from there. We add pieces. The next chapter is on inside and outside money and the lender of last resort. A chapter on money and growth, with a special focus on how China financed its growth. Chapter on fiscal and monetary policy coordination, and the last chapter is on money, the sovereignty attributes of money, and a new take on the theory of optimal currency areas. So that's the outline, if you want, of the main chapters in the book. And so let me start with a few observations about critique of monetarism. And here I'm going to keep it very simple and general. Basically, the monetarism builds on quantity theory of money. Quantity theory of money says that there's a one-to-one relation between quantity of money and price level. Okay? And Friedman and Schwartz, in their founding article, they basically developed that. So you have the two propositions here. Something that most people probably don't know, and I think people will discover, is that when Friedman and Schwartz wrote their article, it was initially in an NBR volume. And these NBR volumes, they have discussants. And their discussant was Hyman Minsky. 1965, yeah, that's really interesting. And Hyman Minsky, in his discussion, lays out some obvious major gaps in the theory. And here you have a quote here. So from his comments, Friedman and Schwartz cast the credit market as one of the supporting players rather than the star performer. Okay, so the monetarists forgot about credit markets, forgot about credit. It's all about money, it's not about credit. Credit is fundamental. How do you think about monetarism when you have credit? And it gets very complicated very quickly, and a lot of the ideas that sound robust and simple are no longer so robust. So that was Minsky. The other thing we observe in the chapter is that so Friedman and Schwartz, they make a big deal about how what they say fits the facts as they were known at the time. Focus on the US history, focus on the recent history on how money aggregates, price level, and GDP growth evolved, and it sort of fits when you look at that time period. It sort of fits what they're saying, but it didn't take long after they wrote their article for evidence to build up in the U.S. was no longer in line with their basic theory. It required more explanation. Okay, so so we go into that in the chapter, but obviously the most important period when you're thinking of these macro aggregates, the relation between money and inflation and growth, where you're really puzzled is the post-Great Financial Crisis period, where things just don't add up. You had high growth in money, in the money stock. You had basically no inflation. And that was over more than a decade. It took post-COVID for this to change, and so this requires explanation. That's incompatible, pretty much, with the basic monetarist doctrine. Okay, so that's for one last thing about the first chapter. The other thing which we do is we say, okay, well, we need to focus also on other countries. We can't just look at the US for evidence, and we do that in the chapter. But one country in particular, obviously, is China. Yeah, and when you look at China, it's even more glaring how the basic proposition of monetarism is not, it's not consistent with the data. So here you see China had M2 growth between 20% and 10% per year over decades, and there was no inflation. However, there was a very substantial GDP growth. So let me now turn to a few remarks about this analogy we're making, money is equity, and the capital structure of nations. If you want, when you think about, okay, so if I can say in one sentence, what makes this interesting? Why you gain by making that analogy? It's that we have a very well developed and rich theory in corporate finance on what determines equity issuance by corporations. One of the leading articles on that is by Myers and Maslow. So these ideas are relevant also at the macro level when you think of money supply, i.e. that's equity issuance, right? If you think of money supply and what should guide money supply, what are good principles for money supply? Okay, now at the heart of at the heart of Myers and Maslow is the idea that when a company issues equity, it may dilute the ownership of existing equity holders. Okay, that's a well-known idea. They flesh out under what conditions that may happen. And then this dilution idea that is very central has an analogy when you're thinking about money issuance. Dilution for equity holders, the analog of that is inflation at the country level, and you can think of inflation costs in similar terms as dilution costs. So one of the observations that Myers and Maslow make is that if you have the old shareholders buy the new shares that are being issued in the same proportion that they hold their initial stocks, then there are no dilution costs, because whatever money is raised is shared in proportion. It doesn't even matter at what price it's issued. It's shared in proportion with all the shareholders, right? Well, there's an analog of that with inflation. If you have, so taking the quantity theory of money, for example, as a basis, if you give everybody the same increase in money, they get an increase in money proportional to their initial holdings, price level goes up, there's inflation, but there are no costs of inflation. People are able to buy exactly the same bundles of goods as before. Prices go up, there's no cost of inflation. Cost of inflation are closely tied to redistribution of purchasing power. And that's another close link with the corporate finance theories. Anyway, we developed that in this chapter. We can derive many of the key propositions that you find for capital structure for corporations. We can derive similar propositions for what we call capital structure of nations, and you get a new angle on these propositions. So let me not belabor that. What I want to turn to next is the chapter on inside and outside money and the rescuer, what we call the rescuer of last resort. Okay, so money creation, obviously you have fiat money creation by the central bank when the central bank prints money. That's typically called outside money. And you have money creation through the banking sector that is generally referred to as inside money. Okay, so you have to take now a richer look at money creation. And that's what we do in this chapter. And so what we develop in this chapter is a model of a monetary economy with a banking sector. okay? And we consider that this economy may be faced with shocks that affect whether it might end up in a crisis or not, shocks to the profitability of the loans, that aggregate shocks, profitabilities of loans that banks have made. And so you may be in a crisis state or in a normal state. And in the crisis state, we set it up, the crisis state, to bring out the key issues. In the crisis state, the banking sector is insolvent. The entire banking sector is insolvent, okay? If you don't save the banking sector, everything collapses. No lending anymore to anyone, and you have a very, very deep recession. If you save the banking sector, I'll say in a second how you might do that, then you can have banks continue to do lending activities, and hopefully they'll do lending that is generating positive net present value investments. So those things don't always disappear, right? They're always present in an economy, especially if you're looking at the whole economy. So allowing for funding of positive NPV investments by the banking sector, by saving the banking sector, that generates value. And that's the reason why you may want to save the banking sector, right? Now, what's interesting, the way I framed it, is that the classical prescription on lender of last resort, the Badgett rule, says you're not supposed to lend to an insolvent institution. Now that works well if the institution is the only one that's insolvent and the rest of the banking sector is solvent. That may be a good prescription. But it's a prescription you really have to think twice whether you really want to apply it if the entire system is insolvent, right? And so we elaborate that, and we develop an alternative approach, what we call the rescuer of last resort, and basically, what it comes down to is that what is productive, what you want to do as a central bank, when you're in a crisis like that, is you want to engineer some form of debt equity swap. You want to recapitalize the banking sector, allow the banking sector to delever by swapping debt for equity. And here, debt for equity, understand it in terms of both inside money for outside money, and the central bank taking an equity position in the banks that it rescues, right? And of course, you take a position, when you rescue an insolvent bank, when you take the equity, think about when AIG was taken over by the Fed and Treasury, they bought the stake essentially at zero price, yeah? Then they saved AIG, and then what happened? The stock price went up. So the Fed and Treasury made a handsome profit. If you add up all the profits that the monetary authorities in the US and Treasury generated from their rescue in the middle of the crisis, adds up to something like $1 trillion. This was a very profitable trade for these authorities. And there was no taxpayer money ever lost from this intervention. In fact, in our model, there are no taxpayers. We're looking now at a stripped-down model. It's only a central bank, a banking sector, and there's no treasury, no taxes, nothing. And so this is partly to really highlight this, to make it more sharp. We obviously link this to how Draghi saved the euro, and let me stop here and hand it over to Haizhou. But what I want you to remember, so this is really why we are thinking this is a very productive analogy to make, because if you think of money supply in terms of equity issuance, then you can take some very productive ideas from corporate finance that give you more to play with in terms of what kind of prescriptions you would like for central banks. When should they increase money supply? When should they not increase money supply? What are the criteria? What are the situations? And so what we're emphasizing, of course, is the positive net present value rule, money supply expansion to stop deflation, and as I said, that for equity swap to rescue the financial system. Last sentence. So if you're looking for a theory of the supply of money, monetarism is not going to give it to you. It's all about rules and it's set exogenously. If you're looking for a theory, a good place to look is corporate finance, because corporate finance has thought very deeply about the equity issuance, the supply of equity. Haizhou, I'm going to hand it to you.
Thank you. It's really a pleasure to have this opportunity to present my research, joining with Patrick Bolton in front of this audience. This is still an FMG show, so David, you're always our boss. So thank you for offering me the first job after graduate school. As Patrick tried to explain, what we try to do in this book and in this project is we try to integrate two literature. One is corporate finance, the other is monetary theory in a way. In monetary theory, we feel that there is not enough discussion about the money supply. So everything more or less is on money demand. On monetary theory, on all that, of course, I'm very lucky to start my career at the SE, learn so much from Charles Goodhart, Marvin King, and Charlie Bean at the SE in this group. Yeah. So this is what we're trying to do. And I will present a few more slides, then I think we'll have time for Q&A. Patrick already mentioned that if we apply this, our framework to think about China's growth, I think it's something very interesting. There are different theories behind China's growth. The importance of institutional reform, the market economy, all that, of course, we think are important. But there is one important question that is not asked, not answered before us, I think, which is how China finances growth. So this finance question is not answered. In a way that if you think about the pace of GDP growth, of course, is astonishing. If you think about the total amount of financing needed, this is mind-boggling. It's something like basically that Europe industrialization, urbanization over 2 centuries, you condense that in like a 40-year period of time, more or less that kind of magnitude in terms of the project, railway, factories, everything that China built. So China, of course, did not borrow that much from international capital markets. So pretty much relying on domestic generated financing, to support its growth. And also that if you really think about the structure of China's financing, equity market did not play that much of a role. But of course, equity market is very important. Why not say it's not important? The reason is that without a functioning equity market, you cannot get lending everything properly. So China used the equity market to reform the banking system, and then to reform some of the large borrowed state-owned enterprise. So much of the financing is done by China's banking system. If you think about the role of banking system in China, it actually contributes for over 90% of all financial activities in China. So much of all this kind of financing that is needed is raised through bank loan and the corporate bond, interbank market bond. So here you see, where exactly we come from. Pretty much it's a loan from financial institutions, and then the big bulk of that is bond. And then, of course, there's something special about China Development Bank that if we have time, we can discuss about that. So in a way that, when people think about this issue, how could China generate so much internal financing without relying that much of foreign direct investment or international borrowing? One role people thought about that, of course, is the reserve that the central bank accumulate, save. But actually, if you think about this, this is the yellow line is the forex reserve. So China's financing growth started to take off before China started to accumulate reserves. And also that after 2011, 2012, the reserve growth actually stagnated and actually come down. But again, think about the credit growth in the banking system, it continued to grow. So there is something very important in this, which is not so much dependent on the reserve. What did China, achieve? How could China achieve this? I think that in our book we discussed the needed reform. The number one reform to start with is reform the central bank. So that's very important. But China's central bank was not a really central bank. It was pretty much like a bursary service to the Ministry of Finance. And the central bank at that time, PBOC, took a deposit and ran deposit and lend to corporations or whatever SOEs. And that need to be separate. So with Bank of England, started with that, but of course the other so-called central bank, they started with the lending department and the money department. So basically that the central bank become a modern central bank, gradually. That's the first step. The second step, of course, China reformed the banking sector. That's vitally important. Remember in the 1990s, the banking system, the whole banking system was insolvent. Patrick talked about the whole system is insolvent. And so large state-owned banks, they all had NPL ratios ranging from 30 to 50%. And that's the case. Because they borrowed the state-owned enterprise, they went bust. So basically that China systematically reformed the banking system by creating good bank, bad bank model, creating 4 large asset management companies, each paired with large state-owned banks, keep out the bad loan so that the banks is left with a quality loan. But of course, the balance sheet is very weak. Central bank provide capital injection. And through Central Huijin Company, the central bank basically took over 40% of share of those companies. And then all those banks, under the guidance of central bank, invite foreign banks, HSBC, Standard Chartered, Citibank, RBS, and all the important, global commercial banks to become strategic investors in those banks. So they transfer the technology, the risk management, everything, and then, through our, Hong Kong market, all those banks were floated through IPO, raise additional capital. But of course, using the capital market to enforce difficult reform of the banking sector. I think that's really the story behind it. Because when that is done, of course, China also had the opportunity to join the WTO, push for this globalization, urbanization, and this huge loan growth through the banking sector. And the banks also become hugely profitable, and they become some of the largest banks, globally. So I think that's a story, and the analysis we provide in that chapter. There is one interesting institution, which is the China Development Bank. That is not really a policy bank. It's not a commercial bank. It's somewhere, in the middle. So that is a very interesting case. We paid special attention, talk about this bank. And it's very creative, and it came from zero and then becomes the largest development bank on earth. Its balance sheet is bigger than all development banks combined, World Bank, EBRD, Asian Development Bank, Latin America, whatever you combine, multiply by 3, and hugely profitable. And it did not really generate much, non-performing loans. That's something that's interesting. So we also have a chapter talk about the fiscal monetary coordination. That's very, very important. I mean, in light of what what's reviewed yesterday, and they will say that the UK Treasury, the new budget, all that. To us, of course, that the very important episode that brought to our attention, of course, is what the U.S. Treasury Department did during COVID. Remember that before April 2020, the U.S. didn't do anything. But of course, the equity market, the capital market was melting down. The capital market in the U.S. had a full short circuit, before the U.S. authorities started to take action. When the authorities started to take action, of course, from April 2020 to April 2021, the U.S. Treasury Department actually ran a deficit of $6 trillion. in market economics, we understand in Europe especially the Maastricht Treaty. So we say that even in a crisis time or in the economic downturn, a country should only issue a deficit no more than 3% of the national GDP, and the accumulated debt should not exceed 100% of the national GDP. What the US did from April 2020 to April 2021, the US increased deficit by $6 trillion, over 20% of GDP, close to 30%. So of course, this is something that need to be analysis. So we provide a chapter talk about this. Now we realize that actually there's a regime of fiscal dominance, and there is also a regime of, we call that money and banking dominance. And the swing is something, every 40 years or so, they swing from one dominance to the other dominance in a way. If we have this so-called money banking dominance, that's basically in the US, UK, and actually in China as well, pretty much since Reagan time. It ran for 40 years or so. Of course, financial liberalization, deregulation, and then of course that asset price is booming. And then of course that the end game is a major financial crisis, and that leads to deflation, lead to zero interest rate or low interest bond, and monetary policy will not be so effective. What do we do? You do physical, is right? And if you do physical, keep doing physical, and you are trapped in that for another 30, 40 years. You run huge deficit, you run into high inflation, and then you couldn't solve the problem. You basically bring monetary and money dominance back. So this is what we document. We actually, even China, follow this kind of trend. It's like every 40 years or so, you have this swing of fiscal and monetary dominance. But this is something that we really need to think about. Even the book focuses primarily on monetary and banking. So we also provide a simple analytical framework to think about the physical and monetary dominance and why physical is needed or important, and when monetary and banking is important. Of course, when there's information sensitivity for private credit is important, you really need monetary and banking to do the job. And if, let's say that if information sensitivity for needed-based physical transfer is critical, say during the COVID, of course, that's the physical can do this as better. But then you need to better coordinate, and then actually, as I explained, that you can easily be trapped in one dominance versus the other dominance. Ideally, you stay away from one dominance or the other dominant. You somewhere stay in the middle, but that's basically what we call, and that's what we suggest. But then you need to reform. You need to do other kind of measures to get it right. The last chapter we talk about money is the sovereignty and the optimal currency area. That's in the area of international finance. So when we think about money is sovereignty, I think that we go back to literature. Part of that, of course, is what Charles did, that two concepts of money. I mean, that we learn a lot. Of course, Charles always emphasized money is sovereignty, and why the king, the queens, the authorities issue money, and why they put their head on the coin. The literature we discovered, the earliest discussion about this is actually 389 BC, and they already, at that time, the king already employed this. But Charles discusses in a very long history. Of course, in terms of the more recent innovation, of course, that's basically that's in China. Okay, is Genghis Khan, and this is Marco Polo's account. This is in Yuan Dynasty. But of course, the paper money was invented in Song Dynasty, in Song and in Yuan, and then they all use authority or sovereignty try to get them issue their own currency. So the question we ask is that how can we understand a global market economy with multiple currencies? When two nations should use one currency, say optimal currency area, or when two nations should use each keep its own currency, okay? Of course, this is highly relevant to the Euro project, right? Britain decided not, to join the EU, but not join the Euro. And I think it's a very, very, very important, very interesting consideration. But other countries in continental Europe decided to join the Euro. The original idea on this, of course, is related to Bob Mondel's work, the optimal currency area. There, of course, everything was rooted in transaction cost. Okay, so one way to think about what we bring, to light in our framework is we rely on control right, corporate governance, corporate finance. We think about in our framework, of course, in a crisis time. If the country has its own currency, the country can issue its currency to do equity swap to save the banking system. That's vitally important for the bank's own financial stability and survivorship. Had Bank of England give that up, 2012 UK economy, all this Euro crisis will hit Britain. That's a very wise decision. So in a way that to give up your own sovereignty is very costly. But what would you gain, and what condition you would gain? Well, Mondale emphasized transaction cost. Transaction cost in financial market on the exchange rate is virtually zero. So it couldn't be, then of course there were all studies try to quantify in the Euro area how much transaction cost is saved and how much additional support for trade. There was very, very little evidence. So that cannot be the right argument. Okay, or in modern time. So what would be the argument? In our framework, of course, when you have two nations at a similar development stage where you have to emphasize this. And then, of course, that one nation can always issue more currency, say the French, issue more currency to buy more industry products from Germany. Germany probably won't do it, but the incentive would be the Bundesbank issue more D-mark to buy more French wine. Okay, I think that would generate a coordination problem. So in a way that there is a trade-off. The trade-off here is based on control right. You give up your control right, but in return, what would you get? Of course, you get away with this strategic monetization game. So that's the idea we discussed in this chapter. That's the optimal currency area. When we look at the optimal currency area, we find something very interesting. In one summer, I went to visit Patrick and Elsa in Colombia. So we read, there was a very nice book about James Hamilton, what he did when he was the U.S. Treasury Secretary. And also we discovered that actually during the U.S. Civil War, there were two currencies issued by two regimes. The greenback and the greenback. The greenback, of course, is issued by the Southern, Federation. The greenback survived. That's by Lincoln, by the North, right? So when the war, the Civil War lasts, when the North win a war, the greenback's value appreciate. When the South win the war, the value of greenback, would increase. So money is a sovereignty. There is no fundamental change of the economic situation in the north or the south. It's only the two armies will fight in the war. Of course, that when in the end that the south completely lost the war, what happened to the greenback? Collapsed to zero, the value. Okay, a lot of people associate hyperinflation, high inflation, to central bank printing too much money. That may be the case, but there are other cases. Of course, when the regime, when the sovereignty is gone, even that the central bank associated with the old sovereignty did not print money, even shrink the money base, that money the valuation would collapse to zero. So inflation is tied to sovereignty. That's basically the idea. This is not so much related to transaction. I think that's the point we had. So here are some concluding remarks. I think what we try to do is try to integrate finance theory with monetary theory. More precisely, corporate finance with the money and banking. I think that's it. So because we incorporate, corporate finance and banking play a very important role in monetary theory. So that's why we can develop a model of money banking and central banking. So what Patrick explained, I think is highly related, for example, to the Dam-Dybvig model. In Dam-Dybvig model, there is no banking. There's a banking called, there's a bank run, is right, but the real economy, there is no money, okay? So basically there is no lender loss result. Talk about deposit insurance, all that. Here we have money, we have banking, then we have, of course, endogenous optimum policy of lender loss result. So the lender loss result takes two forms. One is the standard budget rule. If it's a single bank problem, you lend to illiquid but sovereign bank against collateral at a high rate. I learned that the high rate from Charles. It's not really penalty rate. A lot of people talk about penalty rate. That's wrong. That's fine. That's, I think that's still a valid framework. However, if basically an economy faces a systematic banking crisis for the whole economy, and that also gives rise to the huge risk of deflation, then I think that kind of budget rule wouldn't work. So here, of course, that budget rule emphasizes entirely on debt intervention. Of course, you lend to, illiquid bank, illiquid financial institution against the collateral at a high rate. That's everything is about the debt, operation. What we emphasize here is that we should do equity intervention. So you basically provide a capital injection. You do equity swap, you become shareholder of the property institution, you pay out the whole banking system. By doing that, of course, that you generate the dilution, which is a nice dilution because you stabilize the price, you deal with the deflationary problem. That's the first beauty of this framework. The second beauty here, of course, is not really the central bank gamble with taxpayers' money. Okay, your central bank print new equity, okay? And then basically it dilutes the original shareholder of the troubled institution, say AIG, original shareholder. Remember, in all the banking regulation literature or lender last resort literature, there is always a moral hazard effect that we need to be concerned, is right? These guys gamble in normal time and then in trouble, then the central bank save it. Here, of course, when they are in trouble, the share will be diluted by the central bank. I think that would address effectively the moral hazard problem. Charles and I worked on lender loss result. I learned a lot, and we actually addressed this two issues. But here, I think we tie this literature nicely. And then, we basically we go to physical, we go to optimal currency area, to internal finance. In a nutshell, what do we do? Is we bring in contract theory and control right into a theory of banking, a theory of money with the banking structure. This is pretty much the ALC I understand. This is Olive Hart's contribution, John Moore's contribution, Patrick's contribution, David, everyone at that time, working on that. And then we talk to monetary economists like Charles, Charlie, and all that, yeah. So this is, the root of this book actually started from FMG when I joined in 1994. I want to take this opportunity to thank David especially. 1994 was very important for me because of my first job. 1994 was also important because David applied for a huge ESR grant, so that SE high new colleagues, so I was one of the lucky colleagues. Since I joined LSE FMG, I was luckily working very closely under Charles' supervision. Talked to David, and then, of course, met with, Patrick and Osa, and had the pleasure to, have met Charlie and others. So that's our report. This book is endorsed by Charles, okay? But so whatever Charles would say to criticize, he would be criticized himself, is right? It's also endorsed by others. And the Chinese edition is published in China. Let me stop here. Thank you. or you can
Can't
sit
I just sit here?
yeah.
Much nicer. This is a splendidly thought-provoking book in many ways, and I do very strongly recommend it. However, I think I'm here to start a bit of a discussion. There are two main sort of areas where the book is very innovative. The first one is the second one, but I'm going to take first, is the rescuer of last resort. And then there's the analogy between money and being the equity of a sovereign nation, which I'll take second. Now, the rescuer of last resort argument, I think, is a very strong one. But where I would differ, I think, from Patrick and Haizhou, so I'm not certain whether that's so, is who should do it. Now, I entirely understand that for reasons of simplicity, Patrick has a model in which there is no government. There's just a central bank and banks and sort of people out there. And in that model, it is, of course, correct that the central bank has got to be the rescuer of last resort. But let's actually look at the real world out there. And when you look at the real world out there, it's actually the government that, in almost all cases, actually does it. And it's arguable, I think, for many reasons, that it actually should be the government rather than the central bank. For one thing, it's got distributional effects, quite large distributional effects, and very difficult distributional effects. Rescuing a mass of insolvent banks will also, unfortunately, rescue the bankers as well, so that you're actually sending a lot of very rich people away with their riches completely untouched, while at the same time, in a world in which there's insolvency and a crisis, there are a hell of a lot of small people whose house prices have gone down, who can't afford the mortgages any longer, small, medium enterprises and so on. And one of the great problems, I think, of the rescuer of last resort is that, as was, I think, shown very clearly in the US, to a lesser extent in the UK, if the government is going to bail out all the banks and the bankers, then there's a cry about, why are you not sort of looking after the smaller people? And which is very difficult to do. So I think that and I think, first of all, that it is a government, not a central bank function, primarily. And also it has implications for your optimal currency area. If the rescuer of last resort is and should be the government, then isn't an optimal currency area one in which there is a central government with command over a central treasury, as well as a central bank? And that, of course, was one of the reasons why, when the euro area came into being, that a lot of us had doubts about it, because there wasn't a central government, and there wasn't a central treasury, and it was going to be, therefore, that much more complicated and difficult to organize that kind of rescue of last resort. That said, and I think an awful lot of things that you say about this are absolutely correct. But I think that, in a sense, you have constrained or limited the discussion by having a model in which there's no government. But you might like to respond to me about that. Let me turn to the first and the more sort of striking analogy, about the analogy between the currency being or money being the equity of the sovereign state. And I think it's a fascinating analogy, but I think that there are some points at which the analogy has is to a degree limited. Let me take a number. First, if I hold an equity, I have limited liability. Your currency holders have no limited liability, and if there's hyperinflation, or if their country is defeated, as the southern states were, they lose everything. Secondly, I can choose to be an equity holder. You know, it's my choice to buy ICI or, you know, equity in a company. If I live in a country, I have no choice but to hold money. And in fact, for various reasons, because I think that I might lose my credit card and some people only take cash, I really have to hold cash. I have no choice in the matter. So there's a degree in which the equity holder has a choice, and the currency holder doesn't. There's also a rather interesting analogy that you might take up and didn't, which is the analogy between the AGM of the equity holders and presumably the equivalent would be the election for the currency holders. And again, there's a certain amount of differences there. In an AGM, it's $1 one vote. In the election, it's one man, one vote. So and also AGMs come round every year. Elections come round only fairly rarely. So there are a number of differences, inevitably, so that the analogy can't be perfect. I think probably the main point where I have a worry is if you think of a shareholder, what they're after is profits are good, losses are bad. So it's straight up, you can draw a sort of diagram, loss bad. You know. Now, what you have done in your presentation, and I think in your book, Patrick, but I'm not absolutely certain, is you looked at what happens when you are deciding, or government or central bank is deciding to increase the money supply. And you do it perfectly. Absolutely right, in every way. But what you don't do is the opposite. You see, the opposite is how about cutting the money supply? If you cut the money supply, then prices go down, and the currency holders are better off. You know, it's like a buyback. Mm-hmm. Now, is that a good idea? And the answer, of course, is no, for a number of reasons, particularly the effective lower bound and all that sort of stuff. So that if prices go down too much, real interest rates go up. So the deflation is a potential disaster. So unlike a shareholder, where it's a sort of a straight line, losses, profits, you know, with utility on one axis and so on, it's not at all the same for currency holders. One doesn't want deflation. Both deflation and inflation provide huge costs, where what the currency holder wants is price stability. And in that sense, it's very different. So that what I would like to see in a sort of, because your book is very good and will sell massively, and so there will be a second edition. And when you get to the second edition, what I would really like to see you do is actually consider the alternative of why doesn't it work in terms of cutting the money supply, because it just ain't symmetric in the way that for a shareholder profits and losses are, you know, it's straightforward. It's not straightforward with currency. And you've got to do it in terms of what happens when the money supply goes down, as well as when the money supply goes up. When the money supply goes up, you're perfect, but you don't look at the opposite. So there's a few sort of comments. Do you Do you want to respond very, quickly to any of these?
Well, I will also want to give Haizhou a chance to respond. But first, I want to thank you, Charles, for engaging with the core idea of the book and testing the limits. And in a way, that's sort of what we want. No analogy is perfect. And maybe this analogy might be less perfect than other analogies. But I think by making an analogy, by testing the limits, you learn something. And you bring out observations and thoughts that you wouldn't necessarily come up with if the analogy had not been made. And I think so. I think of your comments in that spirit, and I think that's a useful process of understanding and digging deeper into the issues. So I can't answer all of your observations about limits, but let me just give you some responses on a few of them. So you mentioned AGMs and voting. That's clearly where you would push things to beyond where they're useful. But I mean, what's interesting is in corporate finance, the voting part of shareholders is basically irrelevant. Most corporate finance analysis.
But so is our individual vote.
They don't discuss it. It's important, of course, in reality, but they don't discuss it. They find that thinking of equity in terms of, what it gives you, rights to a dividend, a residual claimant. It's different from fixed income. Think about Modigliani Miller. Where's the voting going on in Modigliani Miller? There's no voting in Modigliani Miller. It's all about how you split up the financing between equity and debt. And if you stay in that analytical world, you can find many useful analogies. So on your first point on rescue of last resort, the government, we don't have a government, we have a central bank. That opens up a much bigger set of issues. So let me just make a couple of remarks here. We could spend hours on this. So, when you have a crisis materializing, think about the Monday after Lehman filed for Chapter 11. Yeah. Everything's imploding. It's a matter of hours, days. Where's the government? Where can be the government? You have White House, you have Congress. What can they do? They cannot respond in real time. The only authority that can respond in real time, put out the fire, is the central bank. And the Fed, of course, completely changed its tack after the Lehman collapse. You go through the whole history of the financial crisis, when Congress intervened, TARP and so on. It was late, it was very chaotic, and it was not super successful. So that's one observation. And I think the other observation is, take for example, during the Asia crisis, you had Indonesia cratered and the entire Indonesian banking system collapsed. Yeah, so they tried to do reorganization for the entire Indonesian banking system. That was very messy and very lengthy. So one point about using the central bank as a lender as a rescue of last resort is that you can do it quickly, you can do it less painfully, because the way you reorganize the liabilities is through dilution of the debt. You don't do a Chapter 11 bankruptcy if you want, where you have to decide which debts you write off, how much, what's the haircut, which is what we did in the US for Lehman Brothers, right? Lehman Brothers was put through a reorganization Chapter 11. Yeah? How long did it take? 4 years. What was left in terms of value of the assets? 30% roughly. It was an incredibly messy, lengthy, inefficient process. You wouldn't want that, and indeed, all the new regulation laws that have been put in place with Dodd-Frank, etc., after the crisis, nobody wants that kind of Chapter 11. They know it's a disaster. Now, you also pointed out, I think it's a very important point, that there are huge redistributional issues, and if you do a bailout of a bank and you do it in a clumsy way, so yeah, of course, you don't want to bail out the shareholders, right? So that's clearly a no. Shareholders are wiped out. Then you have what you call the bankers, the CEOs, the executives of the bank. There you're often bound by contractual obligations. So when AIG was rescued, the shareholders of AIG, Hank Greenberg, he was wiped out. He was very bad. The executives of AIGFP, they got paid. They had long-term contracts. It created a huge scandal. But in the end, U.S. government, U.S. Treasury had no choice. They had to keep them paying them. They had to be paid because although the whole mess was created to a large extent by AIGFP, to undo the mess, only they knew how to do it. And you had to continue to employ them, and they had very hard contracts. You had to keep paying them. So of course, this is these things are. That's the reality. When you have a crisis, you can't do, your first best intervention. It is very messy, but I think we're opening a door on something that may be an option, not necessarily the most desirable one, but maybe an option, maybe a desirable option, and we're sort of walking you through of what you achieve when you do that in the chapter. I think that's a chapter. I think my favorite chapter in the book is what Haizhou covered, how China finances growth. I mean, if you only have limited time or read one chapter, that's the one to read. My second favorite chapter is the one on rescue of last resort, because we're really digging into the difference in how you think about rescues when you do it in a monetary economy through money intervention. That's not something you can do in Diamond Dippic. Diamond Dippic, it's a real economy, and it's actually a mystery how the lender of last resort works in Diamond Dippic. Here you have lender of last resort or rescue of last resort working through outside money printing and outside money being swapped out for inside money. Anyway, I don't want to go on too long. Sure, Haizhou, you have things you want to add to what Charles said.
Yeah, I think that Charles made a very important point, and we'll continue this discussion after today's event. I think that you emphasize on the price stability. No inflation, no high inflation, no deflation is vitally important. That's we fully agree. And although our model appear to be focused on this inflation side, but actually the risk of last resort there, we talk about how to address deflation. So our approach is a bit symmetric. Yeah. So maybe I stop here so that we can have time for discussion with the audience, I guess.
Yeah. I go to the front.
Yeah. Please. Yeah.
Thanks. Actually, I'm going to ask a question. It's not a very good question, but I'll ask it anyway. We're going to open it up to you guys. So I'm just thinking about RBS in the UK. So RBS got rescued effectively by the taxpayer. So a large chunk of it's taken under the taxpayer's balance sheet money. In your world, it would end up being taken over, a chunk of it would go on to the central bank's balance sheet for this equity transaction that you're talking about. Now, we suffered for a long time with RBS hanging around on the government's balance sheet for a long time. Stock market sank. I mean, even today, the government still never got all its money back, etc. So, do you want to just say a little bit about why your world missing out the great power of the taxpayer might have forced us to dealing with RBS perhaps slightly better? You think we would have done better if we just done it your way rather than the way we did it?
I have some thoughts, but I want to leave Haizhou go first.
I guess that central bank print money is not something that taxpayer need to pay interest or anything on that. I think that's very different. It's like during crisis time, no other of the institutions can raise capital through equity issuance. The only institution that can do it is the central bank. That we in our framework, money is equity is right of the nation. Central bank can issue that equity even in crisis time.
Yeah, well, the use of the central bank's balance sheet, quantitative easing and all that kind of stuff. Charles and I never taught any of that stuff in the good old days when we did monetary economics, but the power of the central bank's balance sheet to alleviate problems is kind of interesting. And there's many things you can do with it just beyond the simple stuff that we've all known and love. So I was just wondering about that. So, okay, let's open it up. I think I'm supposed to follow some rules. Alistair, right? I'm going to come to you, right, just to prove I know what rules are, just to impress you all. So can you just say who you are and then ask your question? And I only want questions. I'm going to take 2 questions and then hand them over to the panel. So Alistair, you go first and I'll come to you. Yeah.
Okay. Alistair Mill, I'm from Loughborough University, but I did my PhD in the financial markets group. I'd like if Patrick and Huang could push a little bit more about this inside-outside money, which you have on the... Because to my thinking, fiat money is actually inside money, at least the way central banks normally behave. So when you see it in QE, they act actually like banks. They acquire a lot of assets and they create liabilities. So there's nothing, in terms of net worth, there's nothing new created. It's a market transaction. Outside money, I think back more to eras of the gold standard, and somebody discovers a great new quantity of gold in South Africa or whatever, and that's or the Spanish silver mines, and that's outside money coming into the economy. So your discussion about inside and outside money didn't quite align with my thinking. But I wonder if you could expand.
We'll let them take that. Now, take this other question down here. Yeah, microphone, please.
Thank you very much for the presentation. My name is Marcelo Ramela. I'm a LSE alumnus and now working with the Bermuda Monetary Authority. By the way, under a currency board, following your book. My question is, you argue strongly for this rescue of last resort and for central bank or government to print outside money, capital dilution, and so on. What would your views be on the substantial policy initiative that the Financial Stability Board, under Draghi's leadership, put in place to end the too big to fail through the key attributes and the resolution framework, which it seems to me aims to steer away central banks and governments from doing exactly what you are proposing. And I would like to hear your views on thoughts on that policy push. Thank you.
Okay, well, let me have a go at these 2 questions. Thank you for these questions. So I think on the inside-outside money, we're just following the definition that from Tobin. We didn't invent these words. We wouldn't want these definitions. We wouldn't want to claim any kind of originality here. So what you have in mind is species as opposed to fiat money, right? So that's certainly a distinction. But I think in the literature following Tobin, it's inside money is what banks are creating through The IOUs they issue when they lend, right? Yeah. And the outside money is the money printed by the central bank. Now, on your question, I mean, it's a very important question. I mean, let's go way beyond our book. So, yeah, I mean, the main problem of the financial crisis, global financial crisis, was too big to fail. It's the too big to fail crisis, and the challenge was, how do we get rid of too big to fail? And enormous amounts of effort has been put in. You mentioned FSB, but, Bank of England, the Federal Reserve, the FDIC, the Dodd-Frank Act, to put in place a resolution procedure for global systemically important banks. That's what's going to be our solution to the too big to fail problem. Yeah, massive amounts of effort put into this. So, has it worked? Is it delivering? Well, we have a test. We have a concrete test. Credit Suisse. Credit Suisse had everything in place to be able to be resolved under G-SIB resolution. It had everything in place. What did the monetary authorities and regulators in Switzerland decide to do? We don't want that. It's too risky, it's too dangerous. We're going to do a merger with UBS, and we're going to provide plenty of liquidity to make sure that that merger succeeds. And it's coming back to this point that I think it's a very deep point, and I think it's to emphasize what the issues that Charles raised. When a big crisis happens, it's, every second counts, and you really need to be able to extinguish the fire very quickly. And I think that's a big driving force of how things happen.
I just want to make a footnote to what Patrick has said. The first time I learned this 72-hour rule, I think it's from Charles, is right? And they say when the crisis happened over the weekend, if by Monday you have not taken action by the central bank, crisis would explode and the whole market would melt down. So the time is of essence. So you really need to put together a strong, package within 72 hours. But if you luckily have the weekend, if you don't have the weekend, you probably have 24 hours. So that's the first point. Secondly, I mean, in this case, I think we find a way to deal with the too big to fail problem. When people talk about the too big to fail problem, of course, it's a moral hazard effect, right? I mean, I'm too big, you cannot let me fail. I mean, I can continue to run this institution, or the shareholders still have the money in the institution. I mean, that's also related to Charles' point. If everything goes well, shareholders, value goes up so much, right? It's a fail is your problem, but you cannot let me fail. So I'm safe. The low bound is provided by, central bank rescue or rescue last resort. In our case, I think we play this dilution, game. In a way, the shareholders will be diluted. AIG, 87% of share transfer to the Fed. Okay, so if you want to play the game with the central bank, okay, you play with your own equity. You can lose 100% of your equity. I think that's something I don't think that they were discussed in the literature or to my knowledge. Yeah.
Charles, do you want to add anything on? Yes, I'll go here and then there, unless there's a young lady who wants to ask a question, because I've got to make sure it's fair and reasonable, you know what I mean? Okay, so down here at the front.
So Rob Baston, I retired 2 years ago from UBS, where I was actually quite involved in the recapitalisation of the UK banks in 2008. And I think the critical thing which Charles makes as a good point is that you need a risk taker of last resort, which is very different than a liquidity provider of last resort. The Bank of England was actually very slow in providing liquidity. The Irish got there first with their bank debt guarantee program. And it actually took the Bank of England quite a while before they caught up. But the critical observation which Gordon Brown and Treaty Videira made was you have to get equity into the banks. And the government is the equity taker of last resort, the risk taker of last resort. Yeah. The point being, of course, that if RBS had gone under, the damage to the economy would far have outweighed what the government has actually lost. So I think It's that distinction between the risk taker of last resort and the funder of last resort. And then a last point, just on Credit Suisse, actually resolution worked because all of the COCOs were bailed in. And if you look at where UBS's share prices ended up, it's the 17 billion that's landed in the pockets of shareholders of UBS, thankfully.
That's a great
I
question.
100% agree with everything you said.
We're going to give you a
100%
chance
agree.
to reply.
In fact, I have a little paper on the AT1s and so on. So it's just to answer that question, I think it's
Carry on
really
with this one. We're not
interesting.
going to take a
The AT1s, that was great. I mean, a lot of people criticized what the FINMA did. But that was great, and it's great it had that ability. But what the Swiss authorities did not want to do is TLAC and so on, right? And so that's the part where, in a way, the tests of the resolution model failed. And I think post-Credit Suisse, there will be greater doubts as to whether that model will really work.
Haizhou, do you want
But one point on that. You say that the Swiss National Bank sort of failed. And when you get a real crisis like Credit Suisse, it inevitably becomes political. And the politicians actually, the central bank may be independent, but the idea that a central bank will refuse to do what the political authorities want at a time when there's a major crisis, it just won't happen.
Do you want to add anything, Haizhou?
No, it's okay.
Over here. That was a great question, thank you.
My name is Peter Denton from I recently started at the bank. I guess I wanted to ask whether you think the rescue of last resort might encourage some kinds of herding, I guess, in the sense that it entrenches the idea that if you all fail at the same time, then it's not so bad as being the single bank that does fail, and by having like a different regime. And then to the extent, and then secondly, the second way it might hurt is to the extent that there's an equity injection without any specifications, you just inject equity, whatever, then there's no reason there's like a moral hazard within that situation, in the sense that a bank is they're going to be as penalized if they're much more in debt than if they're not. And so you might see last gasp attempts to like massively leverage at the last minute, and then if there is specifications, then you end up with state-directed terms which might encourage ex-ante herding in terms of lending practices. And then the final point maybe to this question is that maybe these things aren't so bad if economic growth primarily consists of like convergence or capital accumulation in a low uncertainty environment. But if economic growth increasingly depends upon innovation, then those herding things might be more costly. And so it might work in China in the 90s, but less so now in the West.
No, maybe. Yeah. So on, I think our chapter on how China financed its growth, we go into, and this is really, Haizhou had, he had a hand in this. He was there. He saw how everything happened. We go into great detail into how Chinese banks with massive non-performing loans, how they've been recapitalized. They were insolvent. How they've been productively recapitalized. And it is essentially a form of a debt for equity swap. And in the last 2 or 3 years, post-COVID, China hasn't done well. Growth is much lower. We have deflation. We have an accumulation of non-performing loans. As deflation worsens, these non-performing loans get worse. Okay, and until very recently, and again, Haizhou had a role in this, in a new position. What do you do when you have face a situation like that? When you have deflation, accumulating non-performing loans. We have the precedent of Japan. Japan had 3 lost decades. Japan had zombie lending throughout the 1990s because Japanese banks were not properly recapitalized, because there wasn't this debt for equity swap. And so what we think is really crucial today is that something like that be done to interrupt the deflation spiral, bring the Chinese banking system back to a healthy state, and allow it again to extend credit to stimulate economic activity. Now, on your second point, the weakness of our intervention, the way we describe it, rescue of last resort, is indeed it does not address moral hazard. That's a weakness. You need to find a way to address moral hazard. The take we have is that moral hazard is not the first issue of concern in the middle of a crisis, in the midst of a crisis. It's something you need to address, in different times in other ways. So the way we address this in our chapter is to say that you need to impose financial discipline. You need to have a budget rule in place when you are in normal times and when you have an individual institution fail, not the entire system. Individual institution fail. You need to establish firmly financial discipline at that point. So that's our take. So you could imagine, financial discipline, for example, being imposed when SVB failed. And then, of course, you have to worry that you have to be careful not to contain the contagion. I mean, that's the kind of thinking we're pursuing.
Are there any other questions? Yes, we'll take these two questions, and these will be the last two. So if you can please, the microphone in the middle here, please.
Shall I start?
Do you have a microphone? Sorry.
Okay. You've got a nice little solution there. It says monetize liabilities, but I didn't understand what that meant. Could you explain how monetizing liabilities will create a seamless resolution?
Okay, we'll take that question and this question as well in the middle of this, the second row here, the chap with the in blue.
Good evening, my name is Huang. I'm an investment strategy analyst at Patrizia. The IMF recently has published in one of their reports that some worry about the level of financing from non-banks. And I would like to know your view on how the rescue of last resort would apply to the shadow bank system. So, apparently Marilyn, professor at BU now, he proposes the idea of dealer of last resort, so the central banking intervening to stabilize money markets, so non-banks still have liquidity provision during the periods of crisis. So does your idea extend to that as well?
Okay, Patrick, Haizhou.
Maybe I can start. Yeah, and Patrick can correct me. Yeah. Monetization here, of course, that you have this dead old hand problem at the national economy that lead to deep deflationary problem. So I think that's really bad for the economy. Deflation is really bad. I mean, deflation actually hurt small guys more. That's Charles' point. I mean, everyone borrowed, everyone had mortgages, right? That's when you have deflation. So I think that we use this monetization as a dilution tool to push up price level so that the deflation problem can be dealt with, and then the economy would have better growth, and there will be more jobs, and for everyone, for small guys. So actually, the subtitle of our book is "New Monetary Principles for a More Prosperous Society." That's what we really care a lot about. That I mean, that's the main purpose of this exercise. In terms of the non-banking activities, of course, that in our model, is central bank and bank is is money banking and central banking in a way. So we did not really pay that much attention to non-banking activities. However, if we look at the 2008, 2009 financial crisis, the U.S. financial crisis, the Federal Reserve went way beyond rescuing banks, Citibank, to investment banks, Goldman, Morgan Stanley, which were not regulated by the Fed, to insurance company AIG, nothing to do with the Fed, to some kind of corporations, which is called Fannie Mae, Freddie Mae, is it right? That's private enterprises. It was a public institution, but it became private. I mean, this is non-financial institutions in a way. And all the Fed rescue everyone. Okay, that's so I think that also when the Fed started to do that, the Fed was so much criticized about gambling with taxpayers' money, and you take so much risk, and you will, basically you will lose credibility, so on and so forth. The record is very interesting. Of course, this is still ongoing, as Patrick already mentioned. The Fed did not lose money in any case of rescue. The Fed made money at every rescue investment. And the Fed made over $1 trillion profit that was transferred to the US Treasury, and that is still ongoing. Why? Because the Fed could not upload 87% of AIG to the market in a short period of time. The Fed still owns some of the stuff, but the value went up a lot. If you think about the US market, which is one of the most advanced economies, you think about the mortgage market, the Fed owns something like 40% of the mortgage-backed securities. You think about another advanced economy, that's Japan. All the equity ETF products, the largest holder is Bank of Japan. How large? Over 90%.
Okay. Patrick, do you want to add anything?
Yeah, just to on the point of, it's a simple point. It's and Haizhou said it in other words. So you basically rescue the bank by swapping out any inside money it wants to swap out for outside money. Essentially, if it wants to borrow, if it wants to exchange deposits for fiat money with the central bank, you let it happen. That leads to a lot of money creation. Yeah, and the money creation has, as Haizhou said, stabilizes prices and stabilizes the real value of the remaining outstanding debt claims. That's the sense in which you monetize the liabilities. You lower their real value because you're supporting the price level through your intervention as a rescuer, which involves a lot of money creation. That's when the Fed intervened in this way, its balance sheet expanded enormously. That was a form of money creation, right? And it was able to avoid a deflation. The U.S. didn't have a real deflation, but it could have had a real deflation. If the Fed hadn't done all these things, was a real possibility. And then on the money market funds, I'm not quite sure what your question was, but money market funds is unfortunately one of those areas where we're stuck. It's a very, very bad product, very bad market. It's extremely vulnerable to the slightest thing in a crisis. It runs on money markets very quickly, and then inevitably when that happens, the monetary authorities step in and they rescue the money market fund. They can't afford to let them go. I mean, the last time we had that happen was after Lehman Brothers collapsed, and everyone regretted that one of the leading money market funds in the US will let go, and created a huge mess.
Okay, so let me bring this to a conclusion by thanking our speakers, Haizhou, Patrick, and of course Charles.
There are books outside.
I'm going to say that, Charles. Don't worry, I know that's part of your script. There are books outside, as Charles said, which Patrick and Haizhou will sign for you if you would like them to do so. So the last thing for me to do is to thank you, the audience, for attending. It's been terrific, and we hope to see you again. Thank you.